Yeah, ladies and gentlemen, welcome to the first virtual roadshow of Swiss Resource Capital and Commodity TV. And it's my honor and pleasure that we have Fiore Gold here for the first time. Tim Warman, the CEO, is here with us. You see him already on the screen. Tim, welcome. How are you?
I'm well, Jochen. How are you?
Fantastic. Great to see you. And just let me allow also in German to say hello to our German participants. Ja, meine Damen und Herren, wunderschönen guten Tag hier aus der Schweiz und auch aus den USA. Wir veranstalten ja die erste virtuelle Online-Roadshow, jetzt mit Fiore Gold. Leider können wir ja aufgrund der Covid-19-Situation keine Live- bzw. Präsenzveranstaltung durchführen. Umso mehr freut es uns natürlich, dass Sie alle zugeschaltet sind und vielen herzlichen Dank schon mal dafür für die Unterstützung und Sie werden es nicht bereuen, es ist eine tolle Firma. Okay, let's switch back to English and just say hello also please to our participants here all over Europe. We have today people here from Monaco, from Munich, from Stockholm, Oslo, Brussels, Hamburg, Frankfurt, Zurich, Zug, etc., Geneva. I really like that. Thanks, ladies and gentlemen, for your continued support also in those shaky times. And you will really like what you see in a minute, as Fiore Gold is a fantastic, by now, small gold producer with approximately 50,000 ounces this year, but already very profitable. And Tim Warman, the CEO, will elaborate that in a second. So let's get started. I put up the presentation, and Tim, I would say the floor is yours.
Thanks, Jochen. So for those who aren't familiar with the story, Fiore is a relatively new gold mining company, entirely based in the United States in terms of our assets, primarily in Nevada. We began producing about 2.5 years ago. This is our third full fiscal year of production. And I think we've very much focused on growing the company from its current very profitable but somewhat small roots. I'll just jump ahead here on the slides to the next.
Does it work?
Bear with me from
there. I do it? Okay.
No. I think we need to go one more there.
Sure. Can you click on it on next, please? Then it works.
It's
at the bottom.
Oh, at the bottom there. Yes sorry, it's very pale. There we go. All right.
No
problem. So, as we said, Fiore began in its current incarnation in 2017. This is our third fiscal year. For those of you who aren't familiar, our fiscal year is a little bit offset. We begin our fiscal year in October 1st and run through to September 30th. So we're currently about halfway through our fiscal 2020. Our Pan mine, which is a producing asset in Nevada, one of the best mining jurisdictions anywhere in the world, we will be producing between 45 and 48,000 ounces this year, generating very strong cash flow from Pan. And that strong cash flow from Pan has allowed us to maintain a very solid balance sheet. The company has no debt. We're very well funded internally. And that's allowed us to focus on growth. That really provides the funding necessary for growing the company. Our first growth project is our Gold Rock project. Gold Rock is located only about 8 miles or sort of 12 kilometers away from Pan on the same property in Nevada. And one of the big advantages of our Gold Rock project is that it's federally permitted and it has all of the environmental permits needed to operate as a mine. In the United States, that federal permitting process is the long and often painful permitting process. For example, it took 8 years to permit the Gold Rock project, but that's now behind us, and that means we can move ahead on our own schedule. We recently put out a preliminary economic assessment on our Gold Rock project, and that shows that Gold Rock is capable of producing about 56,000 ounces a year. So in combination with the 45 to 48,000 ounces from Pan, that puts us up over 100,000 ounces of gold production in Nevada. The economic numbers from the PEA on Gold Rock look very good, and there's plenty of room to improve that as we go into a feasibility study, which is already underway. Again, we want to continue to grow the company. Our goal is to be sort of 150 to 250,000 ounce producer, ideally focused in the U.S. And interestingly, if you're looking, particularly as a U.S. investor, to invest in a 100% domestic gold producer, we are currently the largest 100% U.S. gold producer, which is a bit crazy, at less than 50,000 ounces a year. But it sounds a lot less crazy and a lot more interesting as you get up into that 250,000 ounce a year profile. And we believe that building a domestic U.S. producer would fill an untapped niche and would be very popular again, particularly with U.S. investors, very comfortable with the jurisdiction that we operate in. So we're looking at additional acquisitions through mergers and acquisitions. There are a number of small single asset producers in the U.S. That don't make really any sense as standalone companies, but would make much more sense bolted together to produce a unified multi-asset U.S. producer. And that's really where we're trying to take the company. We have a third asset that we have called Golden Eagle. It's also in the United States, but it's in Washington State, not far from the Canadian border. We just released a 2 million ounce M&I resource on that project. And we think that project would be very interesting as a spin-out asset. And I'll talk a little bit about that. I should also add that, all three of these assets, we picked them up in 2016 as part of a bankruptcy process. The previous owners had spent about $100 million US building the Pan mine in 2014, but they ran into some technical issues in 2015 and went very quickly bankrupt. We picked up all of those assets for $5 million in 2016, and so obviously a very good purchase, basically pennies on the dollar. I'll just talk a little bit about the COVID-19 impact. The impact has been quite varied around the world on the mining industry. And fortunately, in Nevada, we've seen very little impact. Northern Nevada is a very sparsely populated area. In our county where we operate, we've seen only 3 cases throughout the whole pandemic. And even though we're taking a lot of precautions, we're separating people, doing a lot of cleaning and disinfection, a lot of enhanced safety and sanitary measures, we really haven't seen any impact. We haven't had any of our employees or contractors contract the disease. We haven't seen any interruption in gold production, any interruption in supply chain, and touch wood, that will continue on. So looking at where we operate, again, entirely in the US, 2 projects in Nevada and 1 in Washington State. And I'll start with the Nevada assets. Our producing mine, Pan Mine, is a very straightforward, simple operation. It's an open pit heap leach operation, very commonly seen throughout Nevada. If you look at it from above, this is an overflight taken about a year ago in May of 2019. And it shows 2 open pits, which we imaginatively call the North Pit and the South Pit. There's a fault that runs down through the center of both of those pits called the Branham Fault, and that controls the location and the source of the mineralization. And the mineralization is a little bit different in the 2 pits. And so in order to keep the mine working, we blend ore from the 2 pits and put it on the leach pad, which you see in the bottom center of the picture there. The leach pad is really just a big pile of broken ore. We apply a dilute cyanide solution to that. We collect it in those ponds, which are those 2 black rectangles at the bottom, and we produce gold in our plant there. So we produce gold doré for sale directly to the refineries. It's really predominantly a gold mine. We don't see any silver of any appreciable numbers at all. And it's also a very efficient mine. We ran this mine as what's called a run-of-mine operation for 2 years. And that really means just blasting the rock in the pits, loading it into the trucks, and hauling it to the leach pad and dumping it. And whatever size the rock came out as we blasted it, that's the size that it went onto the leach pad. More recently, in July of last year, we commissioned a crushing circuit to crush the rock down into smaller particles that gives more exposure to the leach solution and gives us better recoveries. We believe it's going to give us about a 10% increase in recoveries and also faster leach kinetics. And we're seeing that in this most recent quarter. And in addition to being a very efficient mine, we're very proud of the fact that it's also a very safe mine. We've never had a lost time injury ever in the history of the company. And we have been the safest mine in Nevada ever since we've owned the property. And that attention to detail really translates through from safety all the way through the operations. If you look at gold production, as I say, we're in the middle of our third fiscal year of operations. We've increased gold production every year. We'll be looking at about a 8 to 16% increase in gold production in the current year over last year. As we go forward, that increasing rate of production will probably start to flatten out. I believe we've probably optimized the mine to the extent necessary. There aren't a lot of changes to be made there. And really going forward, the focus is going to be more on exploration and just continued operations. We've kept a very good control on our costs. It's not the lowest cost mine in the world, but it's still a very profitable mine. Our costs are largely impacted by the amount of stripping we have to do to get at the ore. So we look at what's called the stripping ratio. We look at how many tons of waste do we have to move relative for every ton of ore. For the life of mine, the stripping ratio sits at about 1.6 to 1, so we have to move 1.6 tons of waste for every ton of ore. And in 2019, that's exactly where we were. And you can see that costs at an all-in sustaining cost basis at the mine site were under $1,000, and at a corporate level, just over $1,000. We've guided as we go into 2020 that the stripping ratio is going to rise temporarily, and that will drive our costs up a little bit. All-in sustaining costs will be closer to the $1,200 range, but we're already through that peak in stripping and starting to come down the other side. The stripping ratio is dropping, and we'll see costs start to come down in the second half of this year. Our most recent quarter was a very successful quarter. We produced just over 12,000 ounces of gold. That's a record for the mine, really showing the impact of that new crushing circuit. We generated $6 million US in operating cash flow, 2.9 million in net income. And if you take that on an annualized basis, and recalling that the realized gold price in Q2 was just under $1,600, you're looking at somewhere in the $20 to $25 million in operating cash flow every year from the Pan mine. And that's really allowed us to focus on growth, both at Pan and at Gold Rock. So as I mentioned, the focus on Pan now is on exploration, on expanding the resources, on continuing to grow that deposit and extend the mine life. We would typically spend somewhere between $1.5 million to $2 million each year on drilling to replace the reserves that we've mined in the previous year. I think this year we've just completed a significantly larger program. We drilled about 18,000 meters of drilling between last fall and up to and including the end of April of this year. Now what we'll do is we'll take the results from that drilling as we get the last results in over the next few weeks, and we'll turn that over to the engineers and the geologists. They will do a new resource and reserve update, and they'll come up with a new mine plan and a new life of mine. And that will come out sometime in the second half of this year. So lots of interesting news coming there. We're pretty confident, based on the results that we've seen from the drilling so far, that we'll see, I think a material increase in the life of mine in the second part of this year. We also, though, this year want to get out and test some of the more regional targets in the area. If you look at the map on the right-hand side of the slide, you'll see the mine in the center, but you'll see within the concession boundary, and it's a very large concession package here. This is just one part of it. The overall concession package covers about 200 square kilometers. It's a very large land package. And all of those red zones you see on the map there, those are exploration targets that were defined by the previous owners, by Midway Gold. They defined them by surface sampling, by rock and soil sampling, by mapping, by structural and alteration and geologic mapping, but they never had a chance to go out and drill those targets. And so we're very excited. This year, we want to get out and start drill testing some of those larger targets. We've actually managed to drill the first of those, called the Mustang target, which you can see just to the northwest of the North Pit. We haven't even seen the results back from yet. The drilling is so recent. But this year, rather than spending sort of $1.5 million to $2 million, given the strong cash flow from Pan, we're looking to spend something like $4 to $5 million on exploration. So generating a lot of exploration news coming out of Pan. With Pan, I think operating really well and the focus on exploration there now, really the growth story is coming from Gold Rock. And Gold Rock, as I mentioned, is about 8 miles or about 12 kilometers away. Pan, in that photograph you see there, would sit just beyond that range of low hills in the background. Those are the Pancake Mountains, which is where the Pan mine name comes from. At Gold Rock, there's a small open pit left over from some mining operations in the 1980s. It shows us very clearly the ore body in 3 dimensions. You can see that sort of pinkish, whitish material in the back wall of that pit. And that mineralized structure runs for about 18 kilometers through the length of our concession package. You can see here on the map on the lower right, the location of Pan relative to the Gold Rock project. You can see they're in that same 200 square kilometer land package, just south of Highway 50. Highway 50 is a highway that runs through this part of Nevada, and it has an interesting name. It's called the loneliest road in America because you can drive for an hour on that road and never see another car. But it's a beautiful paved highway that runs through this lovely Nevada high desert scenery. It's like something out of an old Western. Gold Rock right now hosts a resource of just under 500,000 ounces. But 80% of that is in the indicated category. It's about 30% higher grade than Pan. And we believe there's a lot of exploration potential at Gold Rock in particular. You can see on that map, the red zones are the currently drilled off and defined resources and reserves at both Pan and Gold Rock. And all those yellow golden areas are all the exploration targets that we have yet to test. If you go north of the highway, just north from the mine here, you will actually get to Kinross's Bald Mountain mine. And Bald Mountain is one of the biggest mines in the area. It has about 2 million ounces of reserves. And the similarity in geology between Bald Mountain and our Pan and Gold Rock projects is what led Kinross to invest in us as a strategic investor back in 2017. They continue to be a shareholder. They own just under 6% of the company. And they've been very supportive, and they're quite interested in the exploration that we're going to be doing at Gold Rock this year. So we will be spending quite a bit on exploration. We want to grow that deposit. We want to grow the size of the resource as we go into a feasibility study over the next 12 to 14 months. As I mentioned, we recently released a preliminary economic assessment, or a PEA, on Gold Rock that really envisages Gold Rock operating as a satellite deposit to Pan. They're very close by. They would utilize the same operating team, the same management team, the same administrative team. They would use a lot of the infrastructure that currently exists at Pan for both projects. You can see on this map how close they are together. There's a black line that joins Pan and Gold Rock on this map. That's the access road. We actually recently built that access road. It's about a 14-kilometer long access road. And by using excess equipment capacity from the mining fleet at Pan, so whenever we had a dozer or a grader or other pieces of heavy equipment that weren't doing anything at Pan, we would send them down to work on that road. And we built that 14-kilometer road for about $20,000 US. It's remarkably cheap. And that road has cut the travel time down to Gold Rock from about 90 minutes previously down to about 25 minutes now. And that's going to be a big aid to us as we go into this major drilling and engineering phase at Gold Rock. You can also see that yellow line that comes in from the west. That's the power line that comes into the Pan mine. We'll tie onto that power line and bring it about 6 kilometers in to the Gold Rock mine to bring power to there. You can see some of the PEA economics on that slide. 56,000 ounces a year, 6.5-year mine life, roughly a $65 million US capital budget. About 15 million of that, so almost a quarter of it, is related to capitalized pre-production stripping of waste rock. We think we can bring that down in particular as we go into the feasibility and start doing some geotechnical drilling, steepen up the pit walls, reduce the waste ratio on this mine. We think there's a lot of upside to come from metallurgical testing. For the PEA, we relied entirely on the existing metallurgical testing that have been done by previous companies. We are currently in the process of doing a fairly extensive metallurgical test work program, and that will carry on throughout the summer. And I think that will show better recoveries, lower reagent consumptions, and generally overall lower OPEX and CAPEX. And of course, a lot of exploration spending there. We want to grow this resource by at least 50% as we go into that feasibility study. We want to show a much more larger and robust project. So that's our Gold Rock project. So that's the growth profile of the company, really getting up organically to that 100,000 ounce a year mark, and then using some strategic M&A to grow the company beyond that. We do have one more asset that I think probably fits better as a spin-out or a joint venture. It's called Golden Eagle. Again, it's located in Washington State. You can see the small location map down there on the lower right. It's just outside the town of Republic of Washington, just south of the US-Canada border in northeastern Washington. Republic is a historical mining town. They produced somewhere around 4 to 5 million ounces of gold between the late 1800s and really in 2017, the last 2 mines in the area closed down. They were both operated by Kinross, that's their Kettle River and Buckhorn mines. We've recently defined a open pittable 2 million ounce M&I resource there, averaging about 1.8 grams per ton, or sorry, 1.38 grams per ton. The biggest issue we have with this property is that in order to put an open pit around that and mine that resource, we would have to push the edges of the pit into ground on either side of us that's controlled by Hecla Mining, obviously a much larger company than we are. So we talked to Hecla. We began talking to them about 2 years ago, looking to have put in place what's called a layback agreement. And a layback agreement allows you to push the edges of your pit into someone else's mining claim in order to mine the deposit on your side of the claim boundary. That discussion evolved as we talked more to Hecla, And they told us that they had drilled off about 1.5 million to 2 million ounces on their side of the claim boundary. And so then we started thinking, well, rather than have two separate deposits right beside each other, why don't we combine these? Why don't we put them into a joint venture or a spin out or some kind of combined entity? And we'd have a 4 million ounce deposit in the United States, which would make it one of the largest undeveloped gold projects in the US right now. And so those discussions are going slowly. Hecla is a larger company. They don't move quickly on anything. They're very conservative, very cautious. And so those discussions are ongoing. One of the nice things is that Hecla recently suggested, well, why don't we bring Kinross into the discussion? Because Kinross has a mill right down the road, about 10 kilometers away by road, on care and maintenance. And maybe they could bring that into the equation and we could do a three-way spin out. And so we talked to Kinross about that. They like the idea, but again, these discussions always move quite slowly. Fortunately, it only costs us about $10,000 a year to hold this property. So it's a very cheap option on getting that agreement with the two larger companies. And really we think there's an interesting value proposition here. Right now, Fiore Gold has about a $100 million Canadian market cap. It's about $70 million US rather. If we were to take Golden Eagle, which is our third project, doesn't get a lot of attention or interest, and spin that out as a standalone project, on its own right now, it would be the sixth largest gold project in the US that's undeveloped outside of the majors. It would sit right behind in terms of size, behind Integra Resources' DeLamar project in Idaho, also in the Northwest US. And that company with a single asset has a market cap of about $150 million right now. And Golden Eagle is a very similar size, a much higher grade, in a similar jurisdiction, and really is getting very little value within Fiore, again, as a kind of overlooked third asset. If we were to combine that with the Hecla assets next door, it would jump up to being the third largest undeveloped gold project in the US in the hands of juniors. It would sit just behind Midas Gold's Stibnite deposit, again in Idaho, another Northwest US project. And that currently has a market cap of around $300 million. So we think there's a lot of potential value to unlock by spinning this project out. But again, it's taking time, and we'll push that ahead, as and when we can. From a capital structure, the company is a very simple capital structure. We have about 98 million shares outstanding. We have 31 million options and warrants. 23 million of those are warrants. Those warrants are priced at $1.70 Canadian. We're currently trading at about $1 Canadian. And those warrants all expire in September of this year. So they really have only about 3 more months to go. Our balance sheet is very strong. We have 9 million US in cash. We have no debt. We have a very strong working capital balance and a market cap sitting today probably closer to $100 million Canadian, 70 million US. But if you look at where we are valuation-wise relative to some of our single asset producer peers and single asset developer peers and small producers and developers, particularly ones operating in some fairly risky jurisdictions like Papua New Guinea and Mexico, we think we still have a long way to go. Analyst coverage, you can see 3 analysts who cover us there from Stifel, Mackie Research and Red Cloud. Recently, a 4th analyst from Desjardins picked us up, and we're looking like we'll have another analyst picking us up in the next week or so.
Tim, what price targets have the analysts?
That's a good question, Jochen. I can't remember off the top of my head, and you'd think I'd know this, but I'll have to get back to you on that. It's certainly north of where we are now.
So make sure that you send us the researchers, please.
I'll do that.
Great. Sorry, please go ahead.
No problem. From a value proposition, I think this just illustrates, where we sit relative to some of our smaller producing and developing peers. And again, particularly companies that are working in much riskier jurisdictions than we are. I think we are still relatively undervalued. I like to joke that I'm a junior mining CEO, and therefore I'm obligated by my employment contract to say that we're undervalued. So there, I've said it, but I believe it in this case. And really, that's the Fiore story. We've focused very much on trying to focus on our operations, focus on execution, do what we said we're going to do. And I think we've done that. We took a bankrupt asset, the Pan Mine, we fixed it, we turned it around, we have it generating cash flow, operating very well. We've installed a crushing circuit there to increase the gold production. We've got the adjacent Gold Rock project. We got that permitted. We got the PEA out, the resource update, and now moving straight into a feasibility study on that. And of course, we have the most recent resource update on our Golden Eagle project. And now, having accomplished all that, we've got a very busy year to 18 months ahead of us. We've got the Gold Rock feasibility study that's already underway. That'll be coming out sometime in July or August of next year, and then straight into a production decision. The goal is really to have Gold Rock operating by 2023 alongside Pan to get that 100,000 ounce production kick. We'll have results from the recent drilling program at Pan still to come out over the next sort of month to 6 weeks. Probably there's a third of the holes or so still left to report. Those will go straight into a reserve and resource update and a new life of mine plan in the second half of this year. Lots more exploration is going to be happening throughout the year at Pan and Gold Rock. And then, of course, hopefully some results on mergers and acquisitions, looking to add at least one more project to our company. And I'll just leave you with a nice view of Pan with the beautiful snow-capped Nevada mountains in the background.
Fantastic, Tim. Thank you very much. Great presentation and very compelling story. I should say also for disclosure reasons that I'm a shareholder in the company, and also Fiore Gold is part of the SRC Mining Special Situations Certificate with Wikifolio. So just that we know that. So we have already a lot of questions from the participants. First question came here from Nico Baumbach. What is your company philosophy? Could you imagine also to, let's say, do a M&A outside of the US, meaning like Canada, for example?
Yeah, so we could. And I think the way I like to look at the philosophy is that if we're looking at a project, the more different it is on a technical basis than Pan, or the further away it is, the better it has to be. Obviously we jump at a chance to acquire another open pit heap leach operation in Nevada because that's exactly what we know. That's our specialty. We know how to operate those well. We wouldn't really have to add to our technical team in order to do that. If we were to say, look at an underground mine or something in Mexico or the United States, outside the United States, I think we'd, it would have to be a better project and we'd have to be much more comfortable with it. So, but yeah, we would look outside. I like the exclusive US story. I realize that may be too narrow and may not be feasible.
Fantastic. Then Tom Callister has two questions. The third one you have answered already with the analysis of the IRR and the sensitivity. First question is from him here. What are your G&A costs? On the one hand, and on the other hand, he wants to get your opinion about the gold market. So you need your crystal ball, please.
Yeah. So, I think in terms of our G&A costs, we try to keep G&A very manageable. Our G&A for the whole company sits at around between $4 and $5 million a year. We have a very small office in Toronto. Myself and our CFO are the only employees there. We don't even have a secretary. Same with our office in Denver, where our accounting team sits, and our chief operating officer and our legal team. That was basically one guy. And then everybody else is out at the Pan mine. So we try to keep that. In terms of the gold market, my guess is probably no more valuable than anybody's on what the gold market is going to do. I do know, though, that I think that there's a real supply and demand
imbalance. I would call
yes,
it.
Exactly. And we simply are not replacing the resources that we're mining, particularly at the majors. Barrick is mining 5 million ounces a year. Do you really think they're discovering 5 million ounces every year just to stay still? And the same goes for Newmont and Kinross and all the other large companies. And people will say, well, the intermediates and the juniors are finding deposits, but they're not finding deposits at that rate. And so, I think this notion of peak gold is very real. And as prices go up, yes, some marginal projects come on board, but you can't just turn a mine on like you can a tap. It takes years and years. Even a simple mine like Gold Rock in a mining friendly state like Nevada with very little environmental impact took 8 years to permit. And some of these really big deposits out there, are in sensitive environments. There's a lot of opposition to them. And you just can't turn on gold supply that quickly.
So gold 2000. Very simple, gold 2000.
Yeah.
We will both like that. So my friend Werner from Frankfurt has a question. Do you need more liquidity, financing, let's say, for expanding drill programs, or do you need to finance then finally for the Gold Rock project, or can you do everything out of cash flow?
Yeah. So, obviously we're generating some pretty strong cash flow, particularly at the current gold market. And so I would say that we are well financed to go through all of the work we want to do at Pan and at Gold Rock, right up to the stage of completing the feasibility study at Gold Rock. We can always do more, but again, I think we're well funded to do what we need to do for the next year or so. When it comes to building Gold Rock, we're looking at probably a $60 to $65 million capex build. Pan does not throw off the kind of goal, the kind of operating cash flow that would be needed to build that. So we would have to look at probably a more traditional debt and equity mix to fund that, as well as our own resources. One of the nice things about Gold Rock is that it's so close to Pan. Really, the banks and the lenders see it as an expansion project more than a new build. And we've got a cash flowing asset there. We've got a proven track record. And so a lot more people are interested in looking at providing project debt for that, and including some of the banks, so we don't have to go to the Sprots and the sort of lenders of last resort. And hopefully that will translate into a lower cost of capital. But that's really a sort of year and a bit down the road.
Fantastic. Tom Callister is asking again on the options and warrants pricing. You refer to, I think, 23 million warrants which are due in September, but altogether I think it's 39, if I got that correct.
31.
Oh, 31. Sorry.
Yeah.
Can you maybe refer on the other prices and maturities?
Yeah. So the remaining about 8 million or so are stock options that are granted to employees and directors. And we believe very much in pushing options right down to the people working at the mine. So everybody except the newest employees in the company have options. About a third of those options would be in the money right now, and about 2/3 would still be, as we say, underwater, or below the current or above the current share price. So.
Fantastic. Good. Then we have a question from Professor Thorsten Denin. Can you please refer to the price to NAV ratio, your valuation and your peer group, your direct peer group? I mean, you already did some peer group analysis here, but maybe you can elaborate a little bit more.
Yeah, and this is where I wish I had our Chief Financial Officer, Barry O'Shea, on the line to jump in, because I'm a geologist by training, and so anytime I have to count higher than 5, I start to struggle. But I think if you look at the peer group, there are a few other small single asset producers. In the United States, we have Northern Vertex is probably the closest to comparable peer. They operate an open pit heap leach mine in Arizona. I think they've probably struggled a bit with their operation as they get started up. One of the others was Alio. Alio was recently taken over by Argonaut, and then really you start to have to look outside the country. To look at other small single asset producers. There's Wesdome and Hart in Canada. Wesdome's obviously been extremely successful with their operations. There are some small single asset developers like Minera Alamos, who's developing a similar open pit heap leach mine in Mexico. And then further afield, there's companies like K92, which is obviously having a lot of success, but in Papua New Guinea, slightly more risky jurisdiction. So, I mean, those are the kind of peer, companies we would typically look at. There's a few others out there, operating in places like Brazil or in Sweden and places like that. But in general, I think even amongst some of those smaller developers, people that aren't even in production yet, our PNAV ratio is still, I think we're still undervalued, in that regard. I don't have the exact number that we're sitting at today at my fingertips,
but I think this is not a problem, because I can connect Thorsten and Barry together, so they can exchange those high-level numbers, I would call it. Then there's a question from Jochen Müller out of Munich. He's asking for the mine life for the Pan mine, as you referred on page 9 on 2023. So is this like the maximum mine life, including the 2018 drilling program, or where do you see the future of the Pan mine?
Yeah,
I mean, you have a large land package, right?
We do, yeah. So right now, if we take only our proven reserves, our what they call the 2P reserves, the mining would extend into 2023, and then we would go into residual leaching, and we'd continue to produce gold for probably 18 months to 2 years after that. Now, we don't think the mining is going to stop in 2023. In fact, we've just done a major drilling program, as I said, this 18,000 meter drill program that's been hitting a lot of really interesting mineralization. and that is going to go into a new reserve and resource update. So we'll have a new reserve and resource statement out in the second half of this year. We'll see a new life of mine plan coming out, and that will look at the mine going forward into the future. So I think we're going to continue to see an extension of the mine life. Again, we try to spend, several $1 million every year, continuing to push that mine life out, and we've been very, very successful in that so far. And we have no reason to think that, that won't continue going forward.
Fantastic. A question from my side. Where do you see, let's say, the impact of doubling the production within the next, let's say, 2 years, hopefully, maybe 3 years, on your all-in sustaining costs, and let's say also on your all-in costs, and also given the fact that you do now a lot of stripping, and this may diminish also, so that you are coming closer to the, let's say, the high-grade ore bodies, or the higher-grade ore bodies. Where do you see, and I don't want to have an absolute number here, because that's impossible to say, but can we say, like, there might be an effect of, let's say, 10% down, or maybe 15% down? Is something like that possible?
Yeah. So, if you look at Pan right now, the stripping ratio is coming down. It peaked at around 2 to 1 earlier part of this year. It's coming down closer to 1.6 to 1, which is the life of mine average. And so obviously, we spend less money moving waste, and so there's more revenue relative to the expenses, and the costs look better. Having said that, I don't think it's never going to be a super low cost mine. That's the nature of the deposit, and it's one of the reasons why we were able to pick it up so cheaply after the bankruptcy of the previous operators. But I think one of the things that will really help lower the cost is when we get Gold Rock into production, we'll have a much larger ounce production profile to spread those costs over, because there are a lot of fixed costs, at the corporate level and both at an operating level at site, that will be spread between the two deposits, and so you'll be sharing those costs, and overall that will actually reduce the cost, not just at Gold Rock but also at Pan. So it'll bring the cost down right across the board, which is why we're so keen to push that into production as quickly as possible.
Fantastic. And of course, a logical question from Tom Callister: aren't you a takeover target?
Yeah, we could be. I think particularly some of the smaller producers, some of the people that are kind of already where we want to be, the companies that are at that sort of 250 to 300,000 ounce production, look at us and say, well, we could pick up near term 100,000 ounce gold production already with a proven track record here, a good team in Nevada, great jurisdiction. Yeah, that would look pretty nice. That's not our preferred option. We like the idea of growing a company, but I've been through takeovers now twice in my career. First time with Aurelian Resources when we were taken over by Kinross, and then by Dalradian when we were taken private by Orion. And sometimes it's the best thing for the shareholders. And at the end of the day, it's not up to management; it's up to the shareholders to decide if somebody comes along with an offer. Of course, nothing imminent.
Okay, yeah, exactly. That's right. And Werner is asking, what price would you accept? I would say the highest possible.
Yeah. Again, it's that's up to our shareholders.
Yeah, exactly. Coming to your shareholders, can you maybe refer a bit to the shareholder structure? Because if you have some anchor shareholders, what has management skin in the game, of course, meaning do you have more than 25%? So making sure that you cannot be easily overtaken, I would call it.
Yeah. So right now, management and directors have about 5% of the stock. None of the management team or the directors were given sort of cheap seed stock when the company was founded. So we've any shares we own, we've bought in the market. And I've bought all my shares. And so we do have skin in the game. We don't have a single large shareholder. Our two largest shareholders individually would be Kinross at just under 6%. And a fund called Don Smith and Company out of New York that has just under 6%. There is a group with accounts at Haywood in Vancouver, one of the brokerages out there. There's two investment advisors out there who put together the original funding to buy the assets out of bankruptcy. In and amongst their clients, they probably have 35% of the stock, but really, not in any one hand. And then really beyond that, it's a lot of high net worth individuals. It's fairly broadly held stock.
Great, fantastic. And also the answer on the price to NAV ratio, my team
Yeah.
member Sönke has already pulled out the numbers. The price to NAV is 0.5 compared to the average peers of 0.7.
Yeah.
So fantastic.
That's there's Barry diving in. So
yeah, exactly. So that's all good. Fantastic. Yeah, super. Thank you. Then there is a question from Thomas from Frankfurt. What are the probabilities of Golden Eagle being separated by the end of this year or until the end of 2021?
Oh, that's a good question. I hope they're good, but again, I can only move this as fast as I can persuade Hecla and Kinross to sit down and actually have meetings. And of course, that's made much more difficult by the fact that we can't even see each other in person now. And I know the corporate development and a lot of the senior management guys at both those companies quite well. And typically, the best way to get these deals done is to fly out to Vancouver and sit down and have a beer with these guys and and really talk it through. And unfortunately, now it's all Zoom calls and things. So I'm hoping that in Canada the restrictions start to lift soon and we can get back to having these face-to-face discussions. But again, I don't know. I would think that maybe it's a 50-50 odds that we get it done this year and maybe a little better by the end of next year if it's going to happen.
Fantastic. Great. So I don't see any more questions here. That was quite a lot. Just let me scroll through here. Yeah, we are fine. Fantastic. So also from my side, I'm fine. And I must say, great company you have. Happy to be a shareholder, to be honest. And it looks to me like that we have a very heavy news flow the next 3 to 6 months, right?
Yeah, absolutely.
Yeah, so that should lift the stuff. And also, as everybody knows, I'm very positive on the gold price here. And it was also quite interesting. We got yesterday from BMO a lot of research about junior producing companies. So they will be definitely, I would say the market makers for the next 5 to 6 years, as BMO expects that really the growth will come from companies like you are. And interestingly, they even expect a growth rate up to 80% in 2024 from companies like you are. So there's a lot of I would call interest then from the majors, and also maybe a lot of possible M&A here. Now when I wanted to close, now the people come back with questions. I love that. Sure. Jochem from Unix wants to ask, we have seen increasing commodity prices lately. Do you already see effects on the OPEX, or do you expect effects here in the next months? If so, what increases can be expected?
Yeah, so interestingly, the only real OPEX change we're seeing from commodity prices is a lower oil price. And that, I think the current price we're paying for diesel, and we buy all the diesel for the mining fleet, even though we use a contractor for mining. Our current diesel price we're paying is about half of what we budgeted, in our budget for this year. So that's it's not an enormous saving. It's maybe $2 to $3 million at most, maybe $1 million, maybe more like $1 million or $2 million in a year annualized. So for a small company like ours, that's significant. We don't see a lot of we're not building anything right now, so things like steel prices and that don't really affect us. And so overall, it's really a positive impact right now.
Okay, super. Then Peter from Zurich is asking, what price can you achieve for your heap leached product? Meaning, are you doing concentrates or doré bars? And what is the pricing for that?
So we produce doré bars.
On site?
Actually are, on site. So we, and they, that the doré bar, for those of you who aren't familiar, it's a sort of impure gold bar. It's probably somewhere in the 60 to 80% gold, and then the rest is kind of accessory metals, copper, and a little bit of silver and bits and pieces, and that gets sent to the refinery for further treatment to make the pure investment grade gold bars. And so we see the spot price effectively. We're unhedged completely, other than a small charge for transportation and refining, we're basically seeing the spot price for gold.
So you have no penalties or stuff for impurities, or no arsenic problems, nothing like that.
No, nothing like that. We it's a very nice doré. We don't have any penalty metals in it at all. And it's really just a small charge for the refinery to do the further refining to get it to the pure stage.
Fantastic. Great. Yeah. So then I think we can close that first session. Tim, again, thank you very much for your presentation and answering also all the questions. Also, thank you very much to all our participants from all over Europe. And I hope this helped a little bit to compensate the non-personal meetings we love to do normally. And let's hope that this COVID-19 nightmare, I would call it, will go soon away and that we can restart September, October with real road shows in all our European cities. And thank you very much. All the best. The most important thing is stay healthy. And I can tell you my recipe, very simple, but this is why I do not have Corona and no COVID-19. Very simple. Gin and tonic kills all bacteria. Very simple. Yeah. And take some red wine for the nerves and you will be always fine. And so from that side, thank you very much. Kind regards to Canada and the US. All the best. And we look forward to a heavy news flow from you. Thank you very much, ladies and gentlemen. All the best and bye-bye from Switzerland and from Canada. Thank you.